Welcome to the Financially Free Journey podcast, and I am your host, Courtney Dyer. Hey, thanks for tuning into the podcast today. The Financially Free Journey aims to dispel the seemingly complex topic of personal finances, money management, debt, savings, investing, and even retirement. And today we're going to be talking all about how to invest strategically during down times in the market or a recession. And during a recession, investors need to act cautiously, but also remain vigilant in monitoring the market because there are tons of opportunities to pick up high quality assets at discounted prices. And these are difficult environments to really navigate through. But if you do your research, it is well worth it. And so in a recession environment, the worst performing assets are highly leveraged. They're cyclical and they're speculative. And companies that fall into any of these categories can be risky investments for potential investors because of the potential that they could, in fact, go bankrupt. And so conversely, investors who want to really survive and not even just survive, but thrive during a recession will invest in high quality companies and really understanding how to look at their financials, their balance sheets, making sure that they have low debt ratios, they've got good cash flow, and they're in industries that historically do well through tough economic times. So when we get into this episode today, I just want you to have a few key takeaways. These are the things I want you to think about as we talk today. During a recession, most investors should avoid, like the plague, investing in companies that are highly leveraged. As I said, cyclical, speculative companies. These are the companies that pose the biggest risk for doing poorly during tough economic times. Next, a better recession strategy is to really invest in well-managed companies that have low debt ratios, they've got great cash flow, and really overall strong balance sheets. And counter-cyclical stocks do really well actually in a recession, and they experience price appreciation despite the prevailing economic headwinds. So just keep that in mind. Some industries are considered more recession resistant than others. Industries like utilities, the consumer staples, discount retailers. We're going to dig a little bit more into that later in the episode. But let's first talk about the types of stocks with the biggest risk. So knowing which assets to avoid investing in can be just as important to any type of investor during a recession as knowing which companies to make good investments and to put your money into. And the companies and assets with the biggest risk during a recession are those that are highly leveraged, as I've said a couple of times, and they're speculative and they're cyclical. And so let's talk a little bit more. I've mentioned it, highly leveraged. What does that mean exactly? So during a recession, most investors would really be wise to avoid these highly leveraged companies that have huge debt loads on their balance sheets. And so I want you to think about it this way. Would you lend money to your nephew who, he can't even pay his current debts? You might be a little leery to give him some more money knowing that he can't already make payments on the current debts that he has. He's highly leveraged. His debt to income ratio is high. It's the same type of concept with companies. Companies that are highly leveraged are really risky and they pose a lot of risk for you as a potential investor. And these companies often suffer under the burden of higher than average interest payments. And this can lead to unsustainable debt to equity or DE ratios. And so think about it this way too. The more leveraged a company is, the more vulnerable it can be to really that tightening credit conditions when a recession hits. So while these companies are struggling to make their debt payments, they are also faced with a decrease in revenue brought on by the recession. These are two factors to consider. And the likelihood of bankruptcy is higher for these companies than those with the lower debt loads. So I also mentioned a couple of times cyclical stocks. And cyclical stocks are often tied to employment and consumer confidence, which are really battered and and torn down in a recession. Cyclical stocks tend to do well during those booming economic times where consumers have more discretionary income to spend on those non-essential or what we like to consider luxury items. And so a couple of examples of this are companies that manufacture high-end cars, furniture, clothing. We've seen a big hit in the airline industry, the cruise industry, movie theaters. These are examples of companies that are really in that non-essential category or that luxury category. And so cyclical assets are stocks that move in the same direction as the underlying economy and are really at risk when the economy turns down. So again, think about when you've got that extra income, that extra money in your pocket, you're out doing extra shopping, you're pampering yourself, you're going out to eat, you're going to the movies. These are the industries that suffer during economic downturns or recessions. So look at your own spending patterns, what you spend your money on when you're flush and what you spend your money on when you're broke. And that's what you need to think about with counter-cyclical versus cyclical industries when we're talking about the economy. So when the economy falters, consumers typically cut back on their spending with these discretionary expenses, right? So they reduce their spending on things like travel, restaurants, any type of leisure or luxury service. And because of this, cyclical stocks in these industries tend to really suffer the most, making them less attractive investments for investors during a recession. Now, I also want to touch on speculative stocks. I've mentioned that a couple of times at the beginning of the episode, but speculative stocks are richly valued based on optimism among the shareholders that hold the share within that company. And this optimism is tested during recessions, and these assets are typically the worst performing in a recession. And speculative asset prices are often fueled by the market bubbles that form during an economic boom, and they have to pop at some point. And so speculative stocks are not yet proven when it comes to their value, and they are often seen as under the radar opportunities by investors looking to get in on that ground floor of the next big investment opportunity. These high-risk stocks often do fall the fastest, though, during a recession because investors typically pull their money from the market and they rush towards those safe haven investments that really limit their exposure to risk and loss during turbulence within the market. So now that we've talked about things that you don't want to invest in, which I did mention is just as important as knowing what to invest in, let's talk about stocks and strategies that typically and historically do well during recessions. So while it might be tempting to ride out a recession with no exposure to stocks, investors really do find themselves missing out on significant opportunities, and that's you. You're going to miss out on a significant opportunity by not being involved in the market whatsoever. But you do need to do your research and talk to a professional and know what is a smart investment decision. And so historically, there are companies that do really well actually during economic downturns and recessions. And as a potential investor, you might consider developing a strategy based on counter-cyclical stocks. And I'm going to talk about what that means. And these are stocks that have strong balance sheets in a recession-resistant industry, okay? So a strong balance sheet, it's a good investment strategy during a recession to really look for companies that are maintaining strong balance sheets, and this means steady business models, and it's despite the economic headwinds that they're facing during a downturn and a recession. And some good examples of these types of companies include utility stocks, basic consumer goods, conglomerates like Walmart, for example, and defensive stocks. And in anticipation of weakening economic conditions, investors often add exposure to these groups within their portfolios. And that's just an example, again, not a recommendation, but examples of industries that do well during economic downturns. So These companies are less vulnerable when they have a strong balance sheet to that tightening credit condition that we talked about earlier with cyclical stocks, and they have an easier time managing the debt that they do carry. And by studying a company's financial reports, understanding how to read those, you can determine if they have low debt, if they've got healthy cash flows, and if they're turning a profit. This is the most important, because as a stockholder, you are wanting to get paid, you're wanting the appreciation in the stock, you're wanting the dividend depending on the type of stock you're investing in. And so you need to know that they have good cash flow and that they are generating a profit. These are all factors to consider before making any investment. So make sure that you take the time to understand how to look at a basic balance sheet and understand if a company is profitable or not. And by studying a company's financial reports, you can determine so much. You can determine if they have low debt, healthy cash flows, a profit like we just talked about. So a recession-resistant industry, let's talk about that a little. While it might seem surprising, but some industries do perform very well during recessions. And as an investor, looking for an investment strategy during market downturns, often, you add stocks from some of these recession-resistant industries to your portfolio. So counter-cyclical stocks, these are ones that tend to do really well during a recession because their demand tends to skyrocket and increase when incomes fall or when economic uncertainty actually prevails within the market. The stock price for counter-cyclical stocks generally moves in the opposite direction of the prevailing economic trend. So during a recession, these stocks increase in value, and during expansion or during an economic boom, these stocks actually decrease. So it's counterintuitive, but that's how we need to look at counter-cyclical stocks. So now, these outperformers generally include companies in industries like consumer staples, grocery stores, discount stores, firearms, ammunition, alcohol, cosmetics, and funeral services. So thinking about those things that do well in an economic downturn. So investing during the recovery, this is the last part I want to talk about. We talked about what not to invest in. So cyclical, speculative assets, highly leveraged stocks are a no-no in a recession. It's not the time to look for the next Facebook, but looking for those counter-cyclical stocks that have great balance sheets, they've got strong cash flow. Really just learn how to dig into a basic balance sheet and understand if the company is profitable. We know that that is a fantastic strategy when it comes to investing during a recession. But now let's talk about investing during the recovery during this economic downturn. So once the economy is moving from recession to recovery, because again, the economy moves in a ever-flowing cycle, and it's inevitable to move from recession to recovery. As an investor, you should adjust your strategy. So you don't want to continue to stay within those same investments. You want to move with the economy. And this environment is marked by super low interest rates and really that rising growth. So, it's things that are risky, leveraged, speculative investments. They benefit from the rise in investor sentiment and the easy money conditions that categorize the boom phase of the economy. And the best performers are those that are highly leveraged, they're cyclical, they're speculative companies that survived during the recession. And as economic conditions continue to normalize, they are the first to bounce back and benefit from really that increasing enthusiasm and the optimism within the market. So things to think about when we're looking at that recovery phase. You want to really know how to move with the economy, how to move through the economic cycle as an investor. And of course, going through this with a professional and really getting their advice on your personal finances. They're going to look at your personal financial statement, what your goals are, what your time horizon is, and they're going to give you a very specific recommendation based off of your personal factors. But this is an overall general strategy to help you understand how to invest during a recession and then the recovery, because the strategy is important to understand as an investor. The more informed you are, the better decisions you can make with your money, building your future wealth. And so with that, thank you so much for tuning into the episode today. I do have to say, the last episode that I put out talking about COVID-19 and your money and resources for you as the listener, we got some great reviews on that. And also thank you so much for all of the support for our new course that was launched recently. And that's at just achieveyourmoneygoals.com. And you can go to my free webinar, register for that if you're really interested in taking your finances to the next level. You're already making great choices by listening to a podcast to help you with your finances and to understand how to make great money decisions. And if you want to take it to the next level, check out my course and my free webinar at achieveyourmoneygoals.com so I can continue to help you on your financially free journey. But with that, thank you so much for tuning in today. If you're not already following us, make sure that you follow us on Instagram. It's at Financially Free Journey. And then at Twitter, it's at Financially J. And I put out daily tips and motivation to help you on your financially free journey. Until next time.